All right, on today's episode of Cedar Harvest, we had Olivia from Allstate Benefits on, and we were touching base on group health insurance. In this case specifically, we talked about level funding and self-funded plans. We're all very familiar with fully funded insurance plans. Well, Olivia is going to teach you how to save money and which industries it makes sense for, how big a company does it make sense for, and just basically just starting to peel back some of the layers on helping you understand how the second highest expense in your business typically can be lowered. If that's important to you, saving money, you might want to take a listen.
Hello.
Hi.
Olivia, how are you?
I am doing good. How are you, Mario?
I'm great. Super excited to have you in here on our podcast. I look forward to learning and picking your brain about self-funding and level funding for group insurance. Historically, we've always been, like I would say, most traditional agents out there selling fully insured plans, which the consumer has no idea what that is. But your traditional Blue Cross Blue Shield, United Healthcare plan that you get from your employer is typically a fully insured plan. And very few consumers or agents, I would argue, really understand these other types of plans, which would be what are called we have fully funded, which are very traditional plans, then level funded, and then even self-funded, right? And these are mechanisms and plans, if I'm not mistaken, have been put in place to help control costs, right? So this is kind of more of a cost containment situation because every company out there is trying to spend as little money as possible. And so it's just like anything else in life, less risk, less cost, right?
100%.
Or excuse me, I said that wrong. Less risk, more cost, and it comes with insurance. Because if you want less risk within your plan, you're going to pay a lot more for the fully insured plan.
Yes.
To make sure you have that out-of-pocket maximum there, which I guess you have that anyways, right? But cover a lot of upfront costs. So before we get going, please let us know. Who are you? Where are you from?
Yeah, my name is Olivia, originally from Wisconsin, live in Arizona now, and I am the mid-market sales executive with Allstate Benefits out of our Phoenix office here. Everything we do is self-funded insurance, group health plans, whether that's level-funded, traditional self-funded, standalone stop-loss, and we really focus on finding cost containment strategies for groups, like you were saying. For most companies out there, their health insurance and healthcare is the number 2 expense for the company after payroll.
No kidding.
Oh yeah, but a lot of companies don't look at that like anything else in their supply chain when it comes to trying to find new efficiencies and trying to find ways to save money and ways to be strategic about it. Even though it's a huge expense, companies aren't looking at it like anything else that they would be sourcing for their business. So we try to provide different strategies for companies and give them the resources, give them options so that they can be as strategic about their healthcare as they're being about anything else that they're providing.
That's really interesting. I mean, you ever heard of why that is? People just don't want to deal with it. It's a dirty word called insurance, and everybody just wants to kind of put it up on a shelf and forget about it.
I think
take your medicine, just pay the bill and walk.
Yeah, I think objectively, it's confusing for most people who have no idea about insurance.
Totally.
There's a lot of big words that they have no idea what they mean. It's a lot of contracts and a lot of fine print that people don't want to read.
Right again.
And so when people think of insurance, you think of a traditional fully insured health plan. You pay your premium to your carrier. And that's just how it works for most people, especially if it's let's say, small business who they don't have a full HR team to be looking into all of the options, or a designated CFO who's trying to find ways to cut costs. So especially for small businesses, you hear this is what health insurance is, you buy this and then you get this coverage, awesome, and it's not something you really take another look at, just because a lot of people don't know that you can take another look at it. There are alternative funding solutions on the market.
Right.
So that's what we're trying to do is kind of preach the good word about all the other alternative solutions.
Sure. So fully insured really is the simplest way for the employer, but it is also the most expensive. So it's kind of the full service of all the group insurance plans. Is that a good way to look at it?
Yeah. So with fully insured, I would say that now it's not necessarily always the most expensive depending on the group and the health of the group, because it is underwritten based just on the census and the demographics of the people, whereas we're underwriting based on expected claims from the group. But there's also no strategy there with fully insured.
And fully insured is just age banded, correct?
Yes.
Yeah.
So there's no strategy with it. You pay your premium. You have no idea where those dollars go. It's all handled and taken care of. But there's not transparency into the data of what those dollars are being spent on, how much you're spending on claims, that kind of stuff. Whereas with self-funded, one, you have all of the data because it's your money and your dollars. And also you are the one who is putting down the money that could come back to you at the end of the year. On a level funded program, that's the claims fund where you're funding it, but any dollars left over are coming back to you at the end of the plan year. Traditional self-funded, you're paying claims as they're incurred. If you're going to spend less than expected, which we hope groups do, 4 out of 5 years, groups perform better than expected, you're reaping the margin instead of the fully insured carrier. So yes, a lot of times it is cheaper, but it's even more about the why, the strategy behind why you're doing it, keeping your dollars in your pocket, as opposed to putting them in someone else's pocket.
Gotcha. So let's jump in a little bit directly into the self-funded, because the level funded, my understanding, is kind of like the middleman between fully insured and self-funded, right? So I think I just heard you say that on the self-funded plan that, let's just say I was the business owner, I had 50 employees. Basically, I'm saying, hey, employee, I'm going to personally insure you. If you go to the doctor, you having a claim or one of these, I'm going to take on that burden up front, whereas typically we would bill the insurance company. Is that accurate?
So to the employees, it doesn't look any different.
But from the employer.
But from the employer's perspective, yes, it's essentially that you are paying up to a certain limit for an employee's claims, and then your stop loss premium that you're paying is where, in this case, Allstate would take over from there.
And so in essence, it's more or less just a higher deductible plan. Is that an easier way to look at it?
Yes. So
the employer pays that deductible? I mean,
exactly. And so how these plans work is there's what we call an aggregate deductible and a specific deductible. So the specific deductible is the most that you'll spend on any one member. So if we set, that's something that the employer can choose what they want to set that deductible at.
What's the lowest number there that the employer could choose?
I think they can choose, it depends on factors of what the group wants. I think it can go down to 10 or 20. It can also be 40, 50, 100,000. Okay. But the employer can choose what they want to be their specific deductible for any one member to hit. And then there's an aggregate deductible for the max that they would have to spend on the group as a whole.
Oh, good. Okay, so I didn't realize that.
Yes.
That makes a lot of sense.
Mm-hmm. So our underwriters estimate, I think it's at 125% of expected claims is what their aggregate deductible is going to be. So they would never have to spend any more than that. So the employer goes into the plan, you're knowing exactly what the maximum amount they would have to spend is.
Oh, worst case scenario.
Worst case scenario.
Right.
But obviously, most cases, we hope that it would come in a lot lower than that. And then they're keeping that money in their hands until they need to spend it. They know I can budget for maybe having to spend this much, but it's not like I'm going to be on the hook for more than that dollar amount.
So that being said, I would think that it's almost a no-brainer for any company if their fully insured plan is going to automatically hit that max that they'd hit anyways. Well, why not roll the dice a little bit and potentially save that $50,000 that you ordinarily would have just paid out in an insurance premium?
Exactly.
Because that's kind of the mindset?
Exactly. Yes.
Right. So it is. I could see where this makes sense only for larger groups. Mm-hmm. So what is the minimum number where Allstate in this case would consider for a self-funded plan? What's the minimum number of lives?
Traditional self-funded, for it to get sent over to our underwriters that way, 100 lives. Mm-hmm. If we have claims data, if they were already on a level funded plan before, they're not coming from fully insured, and we have all of the data about how their plan is running, we can look at it for groups that are smaller. But again, most groups in that size range don't really want to go that route unless they have all their claims data from being on a level funded plan and they know that they run really well. But generally, if we're looking at it, it's going to be in the 100+ space. Because we have a fully funded plan for our business, could I call United Healthcare and say, hey, I'd like to see my expense breakout? Is that something I can actually ask for? They are very, very stingy with the data that they'll give.
Even to the consumer?
Yes. So as a group, there's very, very limited data that you can get about how your plan is running, all of that kind of stuff. And that's a big benefit of the self-funding too, is you can't make great decisions for your business if you don't have the data to back it up.
Boy.
So we give as much data as possible to the groups, obviously abiding by HIPAA regulations and things like that, but as much data as possible about what providers people are seeing, how much we're spending on claims, what drugs people are getting, that kind of thing, so that groups can then use that data to be strategic about the decisions they're making. Obviously, we hope that that means staying with us year after year, but we want them to have the information that they can so that they can go out to market and know exactly what's going on in their group to then make a good decision for their business.
So it sounds like level funding is that kind of that bridge for people who are going from fully funded to self-funded.
Yes, a lot of times it ends up being the stepping stone on the way to a traditional self-funded
Let's give it a
model.
shot.
Yeah,
But
still a level monthly payment you can budget for. You know what it's going to look like. And basically, it's just paying for the claims up front by funding a claims fund to pay them as opposed to paying them as they're incurred.
So does the business owner incur a lot more paperwork in this? I mean, is there a lot more for compliance purposes? I would think that there'd be. Do you have to use a TPA or anything, or who's are you guys the TPA? Who's tracking this information?
Yeah, so Allstate is the plan manager and the stop loss carrier. We have a couple different TPAs that we can use. Generally, on pretty much all of our bundled solutions, bundled being the traditional self-funding or level funding, we use Allied Benefits as our TPA. In certain parts of the country, we can also use Meritain, but I think Allied is the TPA on 95% of the groups that we have. So we're fully integrated with them, and that takes that admin, that paperwork, that heavy lifting away from the group and puts it into the hands of the TPA.
And also the legal liability.
Yes, exactly.
Right? I mean, it's real. Legal liability for large companies. You got to pay attention. Okay. All right. So it sounds like it's kind of a little trickier to set up maybe up front by comparison to a fully funded plan, but it sounds like once everything's set up and you have your TPA, which obviously you're going to have to pay them, so there's an additional cost.
And that's baked in. So when
is that baked in?
Yeah, when we're looking at a quote that we would send over to you guys, level funded, it's split into 3 line items: admin costs, which is that TPA cost, the stop loss premium, and the claims funding. Traditional self-funding, it would just be the stop loss premium and the admin costs. You wouldn't be funding a claims account because you're paying it as they come in. And then we can also just sell the stop loss coverage if a group wants to go find their own TPA and find their own PBM, pharmacy benefit manager.
Why would they want that? Just they're so big.
Yeah, it's generally really big groups that are wanting to kind of...
They have a department where they really specialize in data analysts and all that.
Exactly. So generally, you don't see that until you're in a couple hundreds, thousands, that kind of thing. But it's an option as well. So you can kind of get as bundled or as unbundled as you would want to be.
So, industry-wide, what percentage savings, dollar savings, would you say on average that large groups are seeing by considering a level or self-funded plan? Do you have that idea? Any idea? Have you heard? Is that like a 20% savings? Is it like a 10?
It really
tell me
depends on the group. Sometimes it can be. I don't even want to throw out a number just because it really depends on the group and what kind of coverage they have and what kind of coverage they're looking for, what kind of network they're choosing. If they want to go full network reference-based pricing, where they are in the country is a big thing. So it's very, very dependent on what the group is looking for. But that's, again, yes, they generally do save a significant amount of money, but even more than the dollar savings, it's a lot of times a strategy play.
Sure. So it is kind of for those business owners who really like to, manipulate the numbers and, save dollars. It's not for the guy who's looking for the quick and easy.
Yeah.
For sure. Okay. So let's get back to some more specific questions about self-funding again. Okay. So let's just roll with, I've chosen the 20, I'm the business owner and I have my 50 employees. And let's just say, it sounds like there's options where I can say I'm going to take care of the first $10,000, clear up through the first $100,000 worth of my employees' bills. Correct? So you're my employee, right? You go to the doctor. You find out, it's a good news. You're going to have a baby. And I'm in let's say a $20,000 deductible plan. And let's say I'm with an Aetna Signature PPO network, right? I chose a really strong network. I think that's what
Signature Administrators, yeah.
Okay, yeah. Which is a super strong nationwide network, right? So me, the employer, so you, the employee, you go to your doctor and you're in your prenatal path, right? And so you're going to the bills are going to be incurred, but they're going to typically they're submitted to. Are they still submitted to to Aetna for network repricing, and then that's what I pay the doctor? Then at what point do I pay the doctor as the employer?
So the employer is not paying the doctor at all. Allied Benefits, the TPA, would be paying on your behalf.
I see.
So you don't even really need to do anything other than putting money into the claims fund. On a traditional self-funded plan, you'd get billed, put money into a bank account that then Allied pays to the provider. So it's not the business owner's responsibility to be directly paying any providers or anything like that. That's kind of where the TPA comes in.
Gotcha.
Receives the claims, sends you a bill, pays the claims, that kind of thing.
As the employer, do I even know that it was Olivia who created these claims? It just comes across, you owe this.
Yes.
Okay,
exactly.
great. For HIPAA purposes.
Yeah.
And
So
your privacy. That makes sense. Okay.
Mm-hmm. And I mean, if I was pregnant and you get a pregnancy claim come in, you'd probably know who it is,
Right,
but
right.
that's not here or there. No, it's all decentralized to the person and what exactly is going on in the situation. But when you get aggregated data at the end of the year, you'd see, oh, what providers are billing us, what amount of money.
So when we start these plans, is it something that the employer from a cash flow perspective automatically has to put in a starting fund, like 10,000, 20,000, 100,000? Do they start with funding this account? With that claims account you're referring to, or does it start bone dry and then pay as you go?
So if you're looking at a traditional self-funded model, it's pay as you go, pay as they're incurred. On a level funded plan, so if there's an expected 125% of claims, that's split up over 12 months. So you're basically funding it at what is expected over the year. In that situation, let's say January, you get a major claim month one, and there's not enough money in that claims account. Allstate will advance the amount of money, and then it'll just get paid out over the next couple months as you continue to fund that claims account. So it's not like you would be on the line for more because there's not enough dollars in that account right now. And then,
but that's for that's for level funded.
Yes, exactly. The traditional model, it is
Traditional
just as they're
self-funded model.
Traditional self-funded model. Yeah, sorry.
Okay, I just want to make sure I want to keep it clear in my own head.
Yeah. So traditional self-funded model, it's paying as the claims are incurred up to those limits, your specific limit, the max you'll pay one person, and the aggregate limit, the max you'll pay for the entire group.
Okay. So you could potentially see if there was a massive couple people that had a couple massive claims, you could potentially, from a cash flow perspective, need to pay that full aggregate amount up front within a couple months.
Yes.
So that's kind of the risks of these plans that the company needs to really be aware of, that you could potentially have to stroke a large check, right? That
Yes.
In a level funding or fully funded situation, it's more controlled cash.
Yes. And that's why it's generally groups that are larger, have more cash liquid, that would be going the traditional self-funded route. Because if they get a big claim month one, they can afford to pay it. And that also means that they wouldn't be paying them after that point in the year, but knowing this is the max amount I'm going to spend in this plan year. Whereas for a group that maybe doesn't have that cash liquid and couldn't incur a big claim month one, because obviously you hope no big claims happen at all, but you can't really control when those come in. Level funded would be a better fit because you know you're paying a certain amount each month.
So is that part of the underwriting process that you guys go through? Me as the employer, are you going to take a look into my financials in order to make sure that I can it's sustainable for me, to make sure I have the liquidity to be able to stroke that big check in case something large is incurred on a self-funded? Is there a financial underwriting for the self-funded plans for the employer?
I would have to look into that for you just because I'm not sure what the financial background is on that side. That may be more of a broker to group conversation of talking to the group, making sure that they're aware of the max amount they could spend. Do they have that amount available? That kind of thing.
Because I guess if you had the credit line out there, it wouldn't really matter. You should make sure you have that.
You have something available.
I would think the business owner would need to be prepared.
Yeah,
right?
exactly.
I mean, part of being in business is don't run out of cash.
100%.
Right? I mean, that's such a big deal. So if you got nailed with something you weren't expecting to get nailed with right up front, that could really be devastating.
Yeah, and so that's the biggest thing with any of our plans to have them run successfully is education, making sure the employer knows exactly how the plan works. The group members know exactly how their network works, or if they're on a reference-based pricing plan, how the reference-based pricing works. Because when everyone knows exactly how it works awesome. But that all comes down to education of making sure that the key players involved are aware of kind of what they're signing up for, what their potential liability could be, and knowing, okay, up to this amount, we're responsible. After this, Allstate stepping in and taking over from there.
Well, good thing we're going to be creating a lot of educational content to teach people, because this is a little nuts. It's a little different. From our experience in being an insurance broker for now 13 years, people are absolutely clueless about insurance. They buy out of fear, not knowledge. If they bought out of knowledge, they would buy self-funded plans. They would take on these high deductibles, save the cash. Speaking from my own personal experience, I owned bars and restaurants before. I had a young family of 4, all healthy. I paid United Healthcare, I think $1,200 a month for a plan that we never used once. My uncle was a doctor across the street. I really only needed to have a high deductible emergency catastrophic plan because I didn't need co-pays. We weren't on medication. So, I could have afforded to take on a lot more risk because there was very minimal risk. But because I didn't have anybody to teach me where the true risk lies, I made a foolish mistake. $64,000. Just United Healthcare took it, and I don't think we had a claim one. Not one. So it's life's lessons. So it's tricky out there for these business owners. I get it.
100%.
So I look forward to making some more content with you and figuring out what is the true educational path that's needed to help people understand what they're missing out on. Thanks so much for coming in today, Olivia.
Yeah, thanks for having me.
I look forward to doing more of these and deep diving a little bit more and help people understand. So thank you so much.
Thank you.
All right, that's a wrap.